What differentiates your strategy from other long-short credit funds?
Well, typically we are very focused on fulfilling two necessary conditions before establishing any position, whether it's long or short. We need to make sure that we're both satisfied on a fundamental basis, so the fundamental analysis is a positive or a negative start, i.e. for either a long or a short position. And at the same time we have spotted a defined calendar of catalysts, which basically means a set of events over a certain timeline that would make the fundamental thesis emerge in the market and in the valuation. So for us, it's really a combination of the two. We wouldn't do investment, or we wouldn't implement a strategy without making sure that both criteria have been fulfilled. On top of that, I would say, as every other investment manager, we have a certain bias or a certain area of specific comfort, and as far as we are concerned, we are particularly inclined to have short position. Parties, because historically that's what we made a lot of our performance in the past, where it was short in Parma, I think it was corporate fraud, as to short in Greece in 2011, thinking that you eventually would have had to restructure. But at the same time is because it's a function of the mathematics involved with fixed income in general and credit specifically, where the upside is very much typically a very small percentage compared to the potential downside in case the credit risk deteriorates. Specifically now, we are at a point where valuations are at historical highs, and both for credit and for fixed income, we're very much close to what is the theoretical maximum value for securities, which is, in the end, the sum of the principal and of all the future coupons. Now, most of fixed income securities are pretty much trading close to that level. Hence, and it may be a very crude, very primitive way of approaching, but you know that your downside is incredibly higher than your upside. Hence, we view as very bearish strategy and short strategy as offering the best payoff profile right now and for the foreseeable future.
And do you expect to generate positive performance in a bonds bear market?
Yes, we had several examples in the past, over the last 20 years, of violent bear markets where we did very well. We would expect to do very well in the case of a generalized bear market, so whether because we have a pickup in growth and then central banks are struggling behind their reaction curve, and so we have volatility across the term structure, across the fixed income space. At the same time, we would make money if there is a very big slowdown in credit, in growth, sorry. So that would impact the credit profile of a lot of the issuers. Again, payoffs are very asymmetric at the moment. There's so more downside than upside, especially in fixed income. The other place where we're looking for opportunity now, and we have plenty of position already in the portfolio, is trying to look at the big macro shocks we have, and we have plenty, whether it is oil price collapsing, or Swiss franc peg exploding, or quantitative easing, or whatever it is, and currency war, and trying to find out how that specific macro shock is filtering through which sector, which company, and why, and then trying to spot the weakest companies around in terms of their ability to manage it, to absorb that shock. And that's, so if it's a bear market because it's a generalized bear market, or it's a bear market because there are several macro shocks that eventually will hit specifically the defined sectors or companies, in both ways we would expect to be in a good position, a profitable position. The third big source of opportunity for us in a bear market is, given the current valuation are very stretched, the amount of sensitivity of any investor is incredibly high. You cannot take losses if yields are pretty much zero or negative because there's no buffer. So because of that, any bad event would create an overreaction in the market, and there will be a great opportunity for us. We've seen plenty of those instances in the past, and that's one of the situations where we tend, as a business, with our research and highly integrated with the portfolio management and systematized research, we tend to be very aggressive, very quick in responding and then implementing strategies that can take advantage of the mispricing.
Finally, what is the best scenario for your strategy in 2015?
Typically, the best scenario is always the one that you predicted and you prepared for. So without being too tautological about it, I would say that our expectation is for the next few months, probably until the summer, for a continuation, especially in Europe, of a very positive trend for fixed income. We still do not know most of the details of the quantitative easing design in Europe, so we need to be prepared for some of the unknowns there, and depending on how it is effectively designed and structured, we may see even a bigger impact of this QE in Europe than what we experience in a situation like US rather than Japan. Having said that, after those 3 or 4 months, we are going back to our sort of base case, which is a proper bear market in fixed income. The valuations are so compressed that at this point, either in 3 or 4 months, we have a situation where central banks eventually are achieving what they are aiming for, which is a pickup in inflation and growth, or a combination of. Or alternatively, if we don't, and we need to acknowledge the failure of central bank policy across the world, from Japan, UK, Europe, US, then we may be into a situation where then we have a growth issue. And at that point it becomes a credit issue. And so in either case, because fixed income and credit securities are nothing else than a contractual obligation to repay a determined amount of cash flow, in either case, whether it's because risk-free rates are going up or it's because growth expectation and cash flow generation ability of issuers is going down, either case we would expect a bear market. So I think 2015 will be, we thought from the end of 2014 until now, I think we are into the inflection point. And the inflection point will be defined by the latest quantitative easing action from central banks, which is Europe, which is the one that was missing in a way. Once we go past that, I think we'll enter into a very different environment, which is always very difficult for investors to adapt. But what we've seen for the last 10 years is not exactly the best proxy to predict the future. I think what we're going to see in the next 1-2 years will be a lot closer to what we've seen in the 2001-2002 bubble, internet bubble, or what we've seen in the early 90s with the fixed income volatility. So that's what we prepared for.